Welcome to the weekly update, where I'll go over the action in the market for the week of September 23rd through the 27th, and then we'll see how things look for the week of September 30th through October 4th. As I get started with this, I'm still in Israel. Things are kind of escalating here. My anticipation is to leave on Tuesday, October 1st, and then be able to do another weekly video next weekend. I'm leaving some charts out right now because they haven't been updated yet. I'm trying to get all of the weekly videos done on Saturday, my time, so that I have free time on Sunday to either run from bombs or go see interesting things. So this is for the week of September 30th through October 4th. Before I start, the daily videos are the real foundation of the analysis that I do. And even if you like the weekly videos, if you can, I would really recommend watching the daily videos. They become public the day of the video right at the market close. Now, if you're a member of the program, you get access to the daily video as soon as it's posted. That's about 6 to 8 hours or so before the market opens. Or if you wait to see it on YouTube or Rumble, it will not become available until the close for that particular day. There is a PDF that's available in the description. Some folks find that helpful to download. They can follow along with the slides that you see here, as well as the charts. Also, every day I update pivot points on the community tab on the YouTube channel, those that apply for the whole month, and then there are those that only apply to that day. I do have a private Facebook group. If you're not interested in being a member in the program, but you still want to have communication with me, you can email me or you can join the Facebook group. It's not really active, but it is available to you if you would like that. I do go through and watch YouTube and Rumble comments. I haven't been getting as much garbage comments from the social media experts, so apparently they're not doing their webinars now. I did get a crazy comment with just a bunch of names in it earlier in the week. I just delete that kind of stuff. But if you have some kind of a comment that you want to make and it's legitimate, by all means, feel free to do that. If you want to keep it more private, send me an email. Videos are also displayed on Rumble as well. And sometimes I've been having really some problems in the hotel that I'm at where the download speeds are great, but the upload speeds are not really that great. So it can take me a while to upload to YouTube and Rumble. I do have a thing called the SPXInvesting Program. You're more than welcome to check that out. It's currently free. It's currently wide open to anybody. After I get back from this trip, I plan on locking that down, and I'll probably be looking at some point in the future, possibly early 2025, to actually begin charging for the membership to that program. If you want to learn more about that, you can email me if you'd like. There's a link below this video that will take you to the website. There'll be a lot of additional things that I do roll out in classes, courses, and additional things that are not available now that will be available after I lock it down and then we go with the membership program in early 2025. There's also a link to take you to a video that explains more about the program. And one of the benefits is you get access to the videos as soon as they are available, both the daily video and the weekly videos. So, as I mentioned before, the daily video is the real foundation of my analysis, with all of the weekly videos being supplemental and they feed into the daily video. Let's go back and talk about this week's session. So, for the week, we were up 0.62% and volume was above average. So, we were seeing that picking up. We are positive, and we're positive on the daily charts too. We have two negative things that are in the background. We have negative seasonality that hasn't seemed to happen yet. And we have a thing called the Hindenburg Omen that has typically been negative in the past, but neither one of those have kicked into gear to this point. So we're still looking pretty solid on the daily charts. We're also looking pretty good here on the weekly charts. We did get the latest reading of core PCI this past week, and it just suggests that inflation is under control. The Fed came in week before last and cut interest rates, and the market likes that. Of course, we want to keep an eye on the geopolitical concerns, specifically right now with Israel. That's kind of a personal matter. We're not really dealing with earnings at this time, and there's still the debate going back and forth. Are we going to go into a recession? There are charts that we look at that suggest we will. There are other charts that we suggest that we won't go into a recession. And I update a video that I don't make public that is on the website that I post ever so often. And then on Monday, Chairperson Powell will be speaking. And of course, the market will really be paying attention to that. As far as our trend, we're still in a weakening trending environment, but it's positive. And I'll show you the chart to go through that. Some bullet points. China seemed to be in the news this week. Where I consult to get a lot of my information, I think they changed the person who does the updates because they just seem fixated on China this week. But it did have an impact on the market. They announced what they're trying to do there is stimulate their economy. They're having some economic problems there. And so they lowered the reserve requirement, the repurchase rate, the medium-term lending facility rate, and hinted at a potential cut in the prime rate there. And they're trying to increase fiscal spending to stimulate their economy. So this helped China, but it also helped companies that do business in China. And there's a lot of S&P 500 companies that, even though they're US companies, they do business in China. And so what happened is Chinese stocks and then stocks in Hong Kong benefited from that. They rose. Europe and the US also showed some strength, not an awful lot in the US, but still it was an up week when we're anticipating that there could be some weakness. Semiconductors were strong, and that helped the overall market to do well. Interest rates ticked up a notch to 3.75 with the 10-year yield, where a week ago we were at 3.74%. And the dollar is in a downtrend and did decline, and that's also helping stocks. The stock market likes a weaker dollar for exchange rate purposes, and it looks better. It's more advantageous on an import-export basis as well. And I mentioned this already, but there's this Hindenburg almond. The Perma Bears love this thing. It is confirmed. We have to have 2 signals within a certain period of time, and those signals have been generated. And we saw one right before the COVID crash and right at the end of 2021. We also are coming into what is typically a weak seasonal time for stocks. But as I also stated, we haven't really seen that develop yet. We're not seeing much confirmation of that in our charts. So we go with what we're actually seeing, not with what we think will happen. So for the week, the Dow was up 0.6%, the NASDAQ up 1%, the S&P up 0.6%, and Russell 2000 small caps were down 0.1%. This is a chart that I've been showing for about a year and a half. We're still in this light blue line area here with inflation declining. Now, if we stick to what's happened before, we could see a real rise in inflation. And there's all kinds of people out there telling you that that could happen. And yes, that could happen. But things may change. We may end up continuing to decline with inflation. We may go sideways. We may see this actually continue to decline from here, or we could really shoot up. So we just want to be aware of this. If we're comparing this period of time in light blue from 1968 to 1982 to what has been happening currently, and there's kind of a similar correlation, but they could decouple from each other at any time. Also, RenMac did some research a while back that suggests that when the 10-year yield is above 4.02%, this is when it starts to affect corporate profits. Well, we're below that. We're at 3.75% with the 10-year yield. We don't have an updated chart here. This will be updated this coming Friday when we get the employment situation report. We'll see how many folks have been unemployed for going on the 7th month. And this is the part that I'm cutting out right now, but you can pretty much guarantee that looking out into the future, earnings are looking good. Next weekend, if I'm back where I'm currently residing, I will do all of the Isabel Net blog charts. But at the time I wanted to record this, that they haven't updated their website yet. FactSet had one post. They say industry analysts project 9% of an increase in the S&P 500 price over the next 12 months. So they're just looking like things are going to go better from here. Then looking at our intraday chart, just covering the week, Monday and Tuesday, we did get up a little bit here. We actually had a down day on Wednesday. And then we saw a real high gap here, but we pretty much set the high right at the open and spent the day coming down, but we were able to bounce back up off of that. We started off positive on Friday, but gave a lot of that back and actually closed below this dark blue line, which is the daily pivot. So for the week, and this is just the 5 trading days for the week, all of the indexes were up, with the mid caps actually showing a little bit of weakness here. And that's kind of strange. Usually these are the companies that benefit from rates going down, but they're just languishing right now. They're actually being outperformed currently over the last week by the small caps. Going back to the beginning of the year, the small caps are still performing the worst, with the Nasdaq performing the best. The S&P, the pink area here, that's in second place, and then the Nasdaq 100. But all of the indexes are positive year to date. The sectors, just going back and looking over the last 5 trading days, we had the materials were up strong and discretionary. This is encouraging. This is mainly Tesla that's driving this. The pun, I guess, is intended there. But this is an area that had been really disappointing in 2024. It just couldn't seem to get going. Well, with Tesla doing better, it's helping the discretionary. And this is like a growth area. And then some of the other economic areas like industrials, we want tech and communication to do well. Those are growth areas. Utilities are still strong. But then we actually had real estate, the financial sector, which is still strong, but had a down week. Energy had a pretty bad week, in healthcare. When we look at healthcare and staples, and to a degree, real estate and possibly even utilities, those tend to be more defensive areas. The market's getting ready to go down, and so those areas tend to see strength. But we've been seeing that for a while now, but it really hasn't led to any kind of significant pullback in the main indexes. Then I rank these a different way. This is called a scooter score on a scale of 0 to 100. At the top, we have utilities looking good, discretionary. They're not in the 90s yet, but they're showing a lot of improvement, followed by real estate, communication, and industrials. And then the weaker areas are healthcare, which that's more defensive. But you look at the chart by itself, and healthcare has been doing well lately. And then the energy sector is actually coming in with the lowest score. So for the week, we had materials, tech, and communication, and discretionary. And these are the 3 growth areas: tech, communication, and discretionary. We want them to do well to keep the market going up, where we had utilities and the other sectors ended up being down. Year to date, utilities are still the strongest, followed by communication. And then the way I measure it on this chart, all of the other sectors are still down. I don't compare it to the S&P. I'm trying to compare just the sectors themselves. The relative rotation graph, what's looking strong? Real estate had been strong, coming down a little bit here, but it's one of the better areas over the last year, and utilities. And these tend to be more defensive. And then the XLP, those are staples. That's another defensive area. Where we see XLK, this is tech turning up, but still looking weak. Energy is probably the weakest area over the last year as well. And then we look at it more in spreadsheet form here with real estate, utilities, staples, financials, and healthcare. A lot of these staples and healthcare, they're defensive. And then we have the more neutral areas with energy, tech actually underperforming. They're red still here. And then we look at the indexes, where utilities are still the strongest index going back over the last year. Small caps have been improving. The Dow Jones Composite average has been improving, seeing some improvement from the transports. The mid caps are showing a little bit of an improvement here, where we're seeing the NASDAQ 100, which really helped the market go higher. It's been actually showing some weakness now. And the S&P 500, because stocks that are in the NASDAQ 100 are also in the S&P, and the biggest stocks in the S&P 500, that makes up the S&P 100, which is the OEX. So we're seeing a little bit of rotation going on here, but we've been seeing this for a while, but it has not really led to any kind of a significant pullback in the indexes, but that could start at any time. Here's looking at it on a spreadsheet basis here: utilities, small caps, and the composite. The composite is the Dow, the transports, and the utilities put together into one average. Transports, mid caps are more neutral, where we're seeing some weakness in the S&P 100, 500, and NASDAQ 100. Sentiment, this is more for jokes, giggles, and things like that. Right now, based on the betting site Predict It, they came down a little bit, but we still have 56 to 48 between Harris and Trump. Looking at sentiment here, we got up into the 72 range. We never got above 75. We're still positive for right now, but we have fallen back since we had a down day on Friday. Here's a look at the chart. Never up to 75. We tend to go with this while it's going up, or go with this as it's going down. When we get below 25 or above 75, that's when we start to use this as a contrarian indicator. The active asset managers, still looking fairly positive, but not extreme right now. Here's another look at that same chart coming in at 86.64. The Ulcer Index is below its moving average. This is another fear gauge that we look at. It's mainly applicable to mutual funds. It was developed a long time ago and just based on the closing NAV for mutual funds. I also have a daily version that I look at here, and it's really been dropping off. We did tick up a little bit here on the closing basis with the VIX, both with the line chart and the bar chart, but we're still below that 20 level, which tends to be more favorable for stocks. This is a historical chart here where a lot of times from September into October, we see the VIX really rise. We're not really seeing that yet. If this is going up, that means stocks are going down. And we look at the RIDEX bear bull ratio. Folks are still kind of bearish on the market now. They don't really trust what's going on. They've been getting whipsawed up and down. We have a big down day, they go bearish. We have a big up day, they go bullish. And then the next day tends to be the opposite. So these poor folks are just not sure what to do. We're still looking pretty good here. When this line, black line, is going down, that means tech is outperforming cash. And that's really what continues to happen here. And here is the ratio again. I don't know why it's there. These got duplicated for some reason. We're keeping an eye on the spread between risky and not as risky bonds. I have another chart right here that inverts that. And we want this to go up if we're more positive. If this goes down, that's more negative. That means more fear is coming in. We also had the latest reading from the American Association of Individual Investors. They're coming in still positive now, but not above this pink line here, above 30. That's when they start to get too positive on things. And then we look at the VIX and take a 3-month average of the VIX and do a ratio. When this is going down, that tends to be more positive for stocks. And we look at a 253 period moving average, because that's usually the number of trading days in a year, of the equity put call ratio. Overall, when this is declining, that tends to be more positive. When this is going up, that's more negative for the stock market. Looking at the economy, we're still below the black line with the National Financial Conditions Index here. So that's suggesting things are okay. We did get the latest reading of GDP this past week. There was no change. They're coming in a little bit over 3% with the GDP now estimate, where the economists out there are looking at about 2.5% to the upside and about 1.5% to the downside. The takeaway is that it's positive, and that's what we see here. Forecasts and consensus going forward are positive for GDP. If we do go negative with the GDP, that probably means we're in a recession. Here's another look at GDP looking forward. The takeaway is that this is positive. We won't get this updated until the employment report comes out. If we go further above that red line, that could be a warning sign for the economy, and we're a little bit above it right now. And this also won't be updated. We're below the red line here, so we're looking okay. And then this is a quarterly look at the index here. It has been declining as of the latest reading. Inflation, we did get core PCE coming out on Friday, so there was a little bit of an adjustment here with the inflation coming out. It actually ticked down a little bit. Looking at the Fed, the next meeting will be November 7th, and there's almost a 50-50 split. It's 53 to 46 here, whether they're going to cut rates even more, either 25 basis points or 50 basis points at that meeting. And this is how that has changed. I don't pay an awful lot of attention to this until we get closer to the meeting. We also look out at the December 18th meeting, where we're kind of all over the board. Most folks think that after that meeting, we'll be down at 4% with the Fed funds, but this changes every day, and it can change fast in one direction or the other. This also shows how it's been changing lately. This is the Fed balance sheet, where it continues to drop off, even though we're getting a positive answer here. Only a government chart. And then looking at the year-over-year change where this is going up as this number's actually been going down. We want to keep an eye on this. We did see this spike up a little bit. This is the overnight reverse repurchase agreements. We just look for anything kind of abnormal here. And since this did go up in the latest reading, we'll just be keeping an eye on that. Is there something to be concerned about? But you can see it often goes up and then comes right back down at other times. Looking at breadth for the S&P, we're positive both based on price and volume. We're looking good here with the new highs. The 4-week moving average and the 10-week moving average are going up. We're above zero and going up with the advanced decline ratio. We're also looking good here with accumulation distribution. We're above the advancing moving average, and we're not necessarily extreme. This indicator, I call it the boom indicator. It tries to measure the distance from the indicator itself from the moving average, but really it's just a modified MACD indicator. Looking at our trend, we are still going down. We're below the moving average, but we're above 20, so we're in a trending environment. We just started a new short and intermediate term trend on the daily charts. So we're positive on the daily charts. We also show the green line. I know there's a lot of lines here. The green line is above the red line, which is at the very bottom, which shows that we are positive with the weekly trend as well. We're looking positive with the Arun. The green are buyers, the red are sellers, and then the difference between the two is the oscillator we see down below. That's still looking pretty good there. The mass index, we're coming up to the red dashed line. This won't really matter unless we go all the way up to the blue line. So we'll see if that ends up happening. And this tries to predict that there will be a reversal in the trend. Long term, first we look at a daily chart where we're well above the 50-day moving average. We did set all-time highs this past week, but not on Friday. And we really dropped off in Friday's session to below average with volume. According to the Keller market model, we're positive with all of the indexes that we follow on all of the time frames. And we're positive with commodities in the short term, but negative in the intermediate and long term. The dollar is negative across all time frames, where stocks and bonds are positive across all time frames. Then we look at some longer term trend charts here. This is the trend channel going back to 2009, where we're still well above the midpoint. We haven't quite come up to the upper end. If we get closer, I'll probably extend this trend line. I keep saying that, but then I look at the chart and go, not quite yet. Then we look at a weekly chart of the S&P, which is going up, and a 50-week moving average, and that's going up, and prices above the moving average. So that's positive. Then we look at the McClellan oscillator. We're above zero and starting to go up. That's positive as well. Then we use a moving average crossover where we take a 13-week moving average above a 50-week moving average. Both of these lines are going up and prices above both. That is positive longer term. We're really looking positive here and possibly too positive. The summation index based on price, we're still continuing to be above zero and going up based on volume. Then we look at the Swenlin trading oscillator, which is declining based on price and volume, but they're still above zero, so they're still positive. And we're looking quite extreme on the daily chart, and here on the weekly chart, we're getting a really high reading with the bullish percent index. That's positive, but you can see other times when we had really high readings like this, look at what happened after that. This is often when we saw, not necessarily in here, but we saw this decline as the S&P was going up. But sometimes that can mark a top in the market. We're just watching to see that actually happen. We're positive with the percent B. The percent B measures when we go outside of the upper or lower Bollinger Band. We're not above the upper band right now, but we are positive since we're above the midpoint. When we look at the price momentum oscillator, we're trying to turn back up with the weekly chart of the PMO, turning back up based on price and volume. And then we have some studies that go with the PMO oscillator, trying to go back up here with the PMOs that are rising. We're declining a little bit with the buy signals. We're looking extreme positive with the PMOs that are above zero. We're also seeing the same extreme reading on the daily chart. We actually are declining a little bit with the chicken money flow, even though we are positive. We've been watching that, and that's been a little bit of a concern. This is a smart money indicator. And if we see some weakness on the daily charts, it'll probably flow through to the weekly chart here. It is showing a little bit of weakness right now, but it's not turned negative. And here are a bunch of different momentum oscillators, two short-term ones that are trying to turn back up. Then I have three intermediate terms, the MACD, the PMO, and PPO, trying to turn back up. we're still declining with the TRIX and KST, which are longer term oscillators. The copy curve is another momentum oscillator. We're positive on the daily chart, but we are negative still here on the weekly chart. And the Chaikin oscillator, still going up and looking positive, or we're actually declining on the daily chart, although we're still positive on the daily chart. The force index, we're above zero in green, that's positive. The money flow crossed back above 50, and that went from being negative to positive. And then we look at a weekly chart of the S&P, and we're well above this R2 level. And that's long-term support or resistance. And we're currently far above that right now. So we're looking pretty good there. The rate of change going back 50 weeks, we're well above this red line, but this is showing longer-term momentum. And then we look at the 1 week rate of change, which we were positive since we're above the midpoint. The RSI based on 14 periods, we're above 50 and going up. That's positive. We're still below the midpoint here with the Stochk RSI, but we are going up. The Williams percent R is extreme positive, and that's positive as well. And we're still below the line here with the weekly chart of the special K, a long-term momentum oscillator. If we could cross above this red line, which we have not been able to do in 2023 and so far in 2024, that would be longer-term positive for the S&P. We declined, but we're still above 50 with the ultimate oscillator. The vortex still has the green line above the red line. Now, on the daily chart, the red line is down and it's getting extreme. It's below this red line where the green line is continuing to go up. What we're worried about here is that the red line is getting a little too negative. And then this is a support chart, longer term, and we're still far above all the lines on this chart. Then we look at a different variation of looking at trend with a Heiken Ashi, where when we have open candles, that's positive. The Kagi chart is black, and that is positive. The Renko has open blocks, that's positive, and the 3-line break has open candles, that is positive. We're also still above zero with the 14-week ease of movement, that is positive. And we had a new X drawn in here when the S&P hit an all-time high. We're also working off of a triple top breakout, which is strange because on the daily chart, it's a double top breakout, even though the charts look very, very similar to each other. This is a momentum study. Long term, pretty much flat. We're still going up in the intermediate term. We actually declined a little bit in the short term. And this is a 50-week cycle. I just use this for illustrative purposes only. Sometimes this means something. Sometimes it means nothing. We are positive when we look at the Elder's Impulse system for the S&P weekly chart, and we're still positive with the parabolic SAR. We are positive with the daily chart as well, and I treat this as a primary indicator. And then looking at the broad market, where we did set a new all-time high this past week with the S&P, the mid caps are pretty much range bound. The small caps have not been able to break out above this range. September tends to be one of the weaker months of the year, and we're usually down over the last few years, 4.3%, but we're showing some improvement. And unless we have a monster down day on Monday, we might end up having a positive month for the month of September. The Dow is still looking solid in an uptrend, as is the NASDAQ. The NASDAQ 100 is also in an uptrend. Here's another chart of the QQQs, which is the NASDAQ 100. The only real concern here is that we're setting all-time highs with the S&P and Dow, but we're not setting all-time highs with the NASDAQ 100. Small caps still looking good, but not really breaking out, but they are in an uptrend. The mid caps also not really breaking out above this range, but in an uptrend. All stocks are looking good. This takes U.S. stocks and international stocks together. The Wilshire came off setting an all-time high on Thursday. This is a daily chart, but had a little bit of a down day on Friday. The FANG index is still above this 13-week moving average, but not setting an all-time high. It's not the big magnificent 7 stocks that are really driving the market right now. The NYC setting an all-time high this past week. The big software companies are showing some strength now. ARK is pretty much chopping sideways and still in a downtrend longer term. The banks have been chopping sideways lately, but we're still above 50 with the RSI, and we're just kind of blubbing above and below here with the MACD to measure momentum. We are seeing money going into commercial banks. The reason I follow this is if people start freaking out about the banks, they're going to start yanking their money out. If they're still putting their money into banks, that just shows some confidence. And we look at a weekly chart of Dow theory, traditional Dow theory, where we set an all-time high with the Dow, but that's not been confirmed with the transports. And even though the utilities have been strong, they're not setting all-time highs yet either. So this is a non-confirmed all-time high with the Dow. And the perma bears love to pick up on that. Okay, some broad market measures here. Here's a weekly chart of commodities. We're seeing them going up, but we're just setting a death cross here with this longer term ratio. Oil, we're watching this mainly for geopolitical reasons, but we're still under 70. Copper, this mainly goes with the economy, and we're going back into an uptrend here as we've been seeing the economy hanging in there for the time being. The dollar is declining, but we're still above the 100 level, although we are still in a downtrend. Gold setting all-time highs, according to the ETF and also the futures contract, which I don't show here, in a solid uptrend. Silver is also in an uptrend, but not setting an all-time high, at least yet. And then we look at bonds here. This is a weekly chart of bond prices, looking really solid right now. And then we do a monthly chart of stock to bonds, take a ratio. When this is going up, that means stocks are still outperforming, even though they've been pulling back lately. This is a daily chart of the yields, and you can see how we've been coming down across all the different maturity time frames. Okay. Had a brain freeze there for a minute. This is a weekly chart of US, UK, Japanese, and German rates, and they, for the most part, have been going down, even though we're seeing UK rates starting to go back up slightly here. And then we look at some relative studies. We start out by looking at an intermarket analysis chart. And I have a whole video called Intermarket Analysis. But if you go back to the beginning of 2024, gold has been doing the best. The black line are stocks. The red line is oil. The green line is the dollar. And the blue line are bonds. Everything is positive year to date. And we do a ratio between the NASDAQ 100 and the S&P 500. The NASDAQ 100 is actually underperforming, and we're seeing a death cross here with this ratio. There's only 100 stocks in the NASDAQ 100, hence the name, and those stocks, the Magnificent Seven, haven't been doing as well lately. Not that they're falling apart, but other stocks in the S&P 500 have been performing better. Then we look at the S&P 100, which longer term is still outperforming the S&P 500, but it has been falling back lately. Then we look at growth to value. We want growth to outperform value when we're more positive on the market. It still is longer term here. We look at the gold to the dollar ratio. The dollar's been going down, gold has been going up, which is why we're seeing a breakout here. And then we do a ratio between gold and the S&P 500, just more or less chopping sideways in 2024. A bond to stock ratio means that longer term bonds still are underperforming stocks. And we look at the low volatility stocks, which tend to go up when the market becomes more defensive, and compare that to the S&P, and they continue to underperform longer term. Discretionary to staples. This is showing some improvement, but still in a downtrend when you compare this ratio. Energy to tech shows how energy is continuing to underperform the tech sector. Then we look at small caps to the tech sector, still underperforming. Even though small caps showed some promise at certain points in 2024, they have not been able to break out of this downward trend that they've been in. Then some long-term studies here. This is an NYC Breadth Thrust, still looking pretty good with this chart. We did get a high reading with the ZWAG NYC Breadth Thrust, but that was not an official signal because we didn't drop down to 0.4. But this is still looking pretty good for the time being. This shows you when we do get a ZWAG NYC Breadth Thrust, what the statistics are going forward. Longer term, we're still looking good here. This line goes all the way back to 1987 when we had the crash. We still have a full Zahorchak buy signal. This is that chart. I just put it in the wrong spot here, going back to 1987. And we see that same chart again, just in case you missed it. Then we look at a QQQ to small cap ratio. We're right around this high level at the blue line. That's still holding up. Then the NASDAQ 100 to Dow ratio also continues to hold up. A weekly chart of the NASDAQ 100 going back to 2009, excuse me, still above this trend line. And we look at a 50-period moving average of the new highs, new lows for the S&P. This continues to go up. That is positive. And then we look at the new highs minus the new lows, also a 50-week moving average for the NYSE. This is also suggesting strength in the broader market. And then we want to keep an eye on the 3-month yield. It's really been coming down like it did back in 2007. Now, we don't know if this is a warning sign or if it's just adjusting to new realities here, but this is what happened. So we just want to be aware of this for right now before we had the great financial crisis. We look at the cumulative new highs, new lows for the NASDAQ, showing some improvement here. On the bottom is a daily score. And then here is the definition of the Hindenburg-Ullman, and here's the chart. We did have a confirmation spike here, and so we'll just see. So far, it hasn't led to anything. It did lead to something before the COVID crash and at the end of 2021. We're still waiting to see if it's going to mean something now. Seasonality. Have a lot of seasonal charts to go through here that show that September is fairly negative, and this breaks it down based on the day of the week. And you might want to pause and look at this. This is more going back to 1950, where we're coming out of September and going into October, but we just haven't seen this weakness. Also, September ends up being bad going back to 1950 on a global basis. We're not seeing it yet. This is another global performance where August and September tend to be weak. And then June, July, and August were positive, where September tends to be negative, but we're not seeing that yet. Also showing how September and even into October can often be weak, but we're not really, well, of course, we don't know about October yet. And then the second half of September tends to be the worst week of, or the worst half month of the whole year. I'm not really seeing that yet. Now, everything could fall apart on Monday, but so far it's looking okay. And this also shows you where September and October are often weak. This takes the S&P and the NASDAQ together, showing the weakness that we typically see that we haven't seen yet. Also showing how September can often be weak. And another one that shows from August through October is often a weak time for stocks. And then during an election year, that's the dark black line here, or dark blue, where we're just not seeing any of the weakness that appears to often happen. And then next week, I'll have the October sheet here. This is for September. We're up 9 out of 18, down 9 out of 18, where the usual return is a minus 0.4%. Thank you. I really hope you found this helpful, and I will talk to you in the next video.